Hi, everybody. Welcome back to the New York Stock Exchange. My name is Dave Vellante, and we're here overlooking the Buttonwood podium at the Options Exchange in the New York Stock Exchange, NYSE Wired, plus theCUBE's AI Capital Series coverage. I'm here with John Furrier, and super excited to have Rob Biederman here. He's the managing partner at Asymmetric Capital. Rob, good to see you. Thanks for coming in.
Great to be here. Thanks for having me.
You're very welcome. Okay, so Asymmetric, let's get a little background on Asymmetric. You guys invest in early stage, disruptive, SaaS, fintech. Give us the lowdown on the firm.
Yeah, so we started in 2021, and we want to partner with founders at the earliest possible stage. So this is before they may even have an idea. Get to know them, people with a track record of success in a lot of different contexts, primarily, obviously, tech and venture. Give them just the right amount of capital to try to get something off the ground and probably try to turn it profitable with maybe fewer than 2 rounds of capital, which is obviously something that's different from the rest of the industry.
Yeah, that's unique. Okay, so you start in 2021, and you're talking about sort of seed rounds of
primarily
hundreds of thousands, or
millions. So
okay,
our typical check is kind of between 1 and 10, but it probably skews on the lower part of that.
Okay, and you take a board seat for that, or?
Ordinarily we do. A lot of early stage investing now is on safe notes, so there's no formal governance at that point, but typically when a board is formed, we will usually join it.
So you'll do a safe, and then you'll price it on the A round?
Correct.
And so what would you say is your unique sort of value to these startups, your ability to sort of sniff them out or provide support? How do you differentiate?
In the game of venture, people find a lot of ways to make money. I think for us, it's certainly identifying people that maybe have not yet hit the broader venture ecosystem. They're somewhere within a large company like a Klaviyo or a HubSpot or a Demandware, and we're able to pull them out, set them up with a little bit of capital, and then get them their first couple customers. We are not technology people, even though I previously founded and scaled a technology company. We are not tech product engineering people. We help with go-to-market, operations, finance, strategy, and I think really world-class technical people actually really enjoy that kind of partnership.
Interesting. So you started in 2021. The market was pretty hot at the time, and in 2022, were you deploying capital in 21 or just?
It was funny. I looked the other day, and we had exactly the same deployment in 21, 22, and 23. I think the difference between us and everybody else in 21 was we looked at a bunch of SaaS deals at 75, 100, 150 times ARR. We said the probability weighted fan on these deals is just not good. So we went and found people at the early days. We could back them at an $8 million pre-money, a $10 million pre-money. And I think our 2021 cohort may end up actually being our strongest cohort of the 3 we've had so far.
Really? Oh, interesting. Okay, 2022 was kind of tough. How are the portfolio runways looking for 2022?
Yeah, I think we've been lucky to partner with founders that have a really good attitude about cash and understand unit economics really well. We made a large investment in 2022 in a Latin American e-commerce company that scaled unbelievably well. So we backed it at around 1 or 2 of revenue. I think they're going to do about 50 million of revenue this year. And they've done it in an incredibly cash-efficient way. We're looking for founders that we think can understand great unit economics and then be able to create enterprise value out of those unit economics. Those thoughts don't always connect in this world.
So the other thing about 2022, if I recall, it was like a lot of the premise at the time was betting on companies with hybrid work or remote work, and SaaS companies in particular, maybe even vertical SaaS, and you guys do some SaaS investments. And then all of a sudden we had the AI heard around the world. Yep. And that threw everything, for a loop. What are your thoughts on that?
Yeah, look, we've made obviously investments in the future of work. The company I founded is a future work company. One of our most successful investments in Fund 1 was a marketplace of nearshore, primarily LATAM software developers that exited to a public company, Randstad. Look, we think AI is an incredibly important trend. It's going to change every single industry. But like any other technological development, it's not the case that you can just throw any kind of dart against the dartboard and make money. 99% of AI deals are going to be big disappointments. The secret is finding the 1% or the 10 basis points of deals that are going to return all the value.
Right. Okay, so that was my follow-up question. Is that the philosophy? And that's most VC firms, if you get 10% and you get a 100 bagger, it works. At the same time, I saw a stat recently that the percent of companies, Series A, B, and C companies that return 1x to their, or less than 1x or less to their investors is the same. It's like 70%, which was astounding to me. Now, you mentioned that you bring go-to-market expertise. I have a premise that part of the reason is because companies try to scale go-to-market before they get product market fit. What's your experience around, are you trying to attack that problem or does it not matter? And what's your experience around sort of scaling go-to-market before you have product market fit?
So I fully agree with that. Look, the challenge of venture capital is historically the returns in the industry are not good. And I think they're not good simply because there's just too much capital in the industry. And there's too much capital in the industry because everybody looks at the one or two companies in a space that scale and wants to fast follow them. And so you end up getting to your point about go-to-market with 10x too many salespeople and 10x too many marketing dollars in any one individual space. So in that way, we almost think of ourselves as kind of anti-thematic. So if everybody is running at going to play soccer, we're going to go play football because maybe football is a slightly less attractive game. But if you have 1/10 the competition, it's far easier to go get customers in that space.
Or maybe women's sports, even a better example, right?
Yeah, for sure.
Okay. You have this buy and build strategy for cash flow positive assets. What is that about? What does that mean?
Well, surely this is nothing new. It's, private equity has been doing add-on acquisitions since the 1980s. I think where we take a different spin on it is we're doing it at super subscale. So a lot of the underlying assets that our platforms are buying are 500,000 of EBITDA, $1 million of EBITDA, $2 million of EBITDA. And they're largely buying them in spaces like tech-enabled services where we think the value of the platform, particularly with technology, can create a huge multiple uplift. I think the other delta is historically folks have focused on industries that have very clear and obvious potential for consolidation. So HVAC, accounting, there must be 100 separate roll-ups in each of those, and a lot of them have done well. We tend to go one spot outside of that. So we have a pool cleaning business in San Diego. We have a sleep apnea clinic in Houston. Neither company you expect to hear as part of a venture capital portfolio, but very, very core to our strategy. And I think very core to why our limited partners are attracted to working with us.
And so the operating leverage comes from the roll-up and the back-end infrastructure that you guys put in place?
Yeah, if you think about a business like a pool cleaning business, there are so many opportunities to be more efficient. And one of the biggest of those is the density of your routes. So if you serve number 1, 3, 5, 7 on Main Street, going to get number 9 on Main Street, hugely incrementally profitable. Going to get one more house that's 10 blocks away, way less so. And our entrepreneur there, who we think is an incredibly special guy, has really techified the entire pool cleaning industry in a way that we don't think that many people have.
Well, like you said, Rob, I mean, it's common in private equity. It's less common, I think, in VC. So I love that strategy. What are your thoughts on physical AI and disrupting some of those industries?
Look, for sure, I think in a lot of relatively low-skilled services businesses, the chance that robots or other automation may be hugely impactful to that process is key. Now, we think of it as more of an opportunity for those companies that we've backed than a threat, because if we already own the customer and we own the brand, substituting robots for humans would be a relatively easy trade, whereas a company beginning just with the pool cleaning robots would have to go out and actually do all of the work to aggregate those houses.
So I got to ask you, so the tech bros on podcasts like All In, they're complaining about how difficult your business is these days and, get out the violin, right? Nobody's crying for those guys. But at the same time, it's true. The exits were much tougher with lack of M&A, IPOs heating up again, but there was just sort of the dog days of IPOs there for a couple of years. And generally speaking, investors are saying, look, we got at least 7 years to 10 years sometimes to actually get an exit and get a return. So how has that dynamic affected your strategies?
For sure. Look, every business is a hard business. Venture capital is historically a really hard one. I think we've been able to separate from the herd a little bit by getting a lot of early liquidity in the portfolio. So we returned 20 cents on the dollar before the third anniversary of our fund. I think investors who participated in Fund 2 were really excited about that because venture's always been a hopes and dreams industry, and it's actually really hard to tell for 1, 2, 3, 5, 7 years if things are actually working. Obviously, one great metric is just how many of the companies are still alive, because if a company has failed, it's probably pretty unlikely to create any kind of enterprise value. We've backed 35 companies since the fall of 2021. 34 of them are still alive, and 3 of them have been happily sold. So I think the focus on consistent unit economics, spending the right amount of capital, and then in a couple cases, getting early exits 2 or 3 years into an investment is something the industry could benefit from a lot more of.
What are your thoughts on the state of AI capital formation? I mean, it's a very bubblicious market. It's like a one-trick pony right now with,
Totally.
Hyperscalers just pounding it, and the market goes up, and everybody's happy. And now, of course, the narrative from the analysts and on CNBC is, oh, is this 1999 all over again? What are the similarities? What are the differences? But how do you think about, that momentum and where to place your bets?
If you read this morning's deal book, it was certainly the case that Mr. Sorkin was expressing some questions politely. Look, I think AI, as I said, is an incredibly important development. It's going to change the economics of every industry. It has certainly been overinvested in. And I think the thing that concerns me the most right now is the order of magnitude of infrastructure bets requires that so much compute is used. And if we have any kind of pullback or deceleration in the amount of compute being used, prices fall. And a lot of the industry is currently predicated on relatively high prices for people needing to use AI. My broader concern about the industry is I don't think anybody's really looking at the ROI right now on their AI spend, because you have boards of directors at public companies and private companies and dry cleaners saying, what are we doing about AI? We need to be doing something. So somebody on their team goes out and signs a contract with OpenAI or with, any of the other providers. And I fear 1, 2, 3, 4 years from now, people are going to start looking at those bills and looking at the incremental revenue they're generating or the cost they're saving and saying these two numbers don't really match. So there are situations, like we had one great portfolio company that was AI for insurance claims. Unbelievable use case, made insurance claims management 10x faster, 10x better. There are other cases like making pretty pictures on your computer that don't really actually create any value, but actually suck up a decent amount of compute. And so
the pets.com of AI.
I think one day there may unfortunately be a reckoning in the amount of spend that people are doing.
Yeah. So that says it's likely going to be a trough at some point.
Yeah.
And then people are going to go, uh-oh, and the music stops, and there's going to be some challenges. So how do you approach value discipline in a market like that?
And it's not something you hear from a lot of venture capitalists. My whole team and I all came from both private equity investing and operating, so I think we bring more of a kind of nuts and bolts valuation orientation. It's a pretty simple process. We basically say, what is the chance based on the amount that we can invest at what valuation that we're able to return a $137 million fund off this investment? So back into that, you basically say, you need to sell it for $1 billion. You own 15% before dilution. You end up 13, 14 after when all is said and done. We don't love entering situations where we either have super low ownership or we're entering at a relatively high valuation, which is obvious. I think one thing that VCs sometimes don't calibrate is the ultimate market size multiplied by the chance of winning that market by how well the cash flows are going to be valued by the public market, by a private equity firm. And if you do that, the average venture capital deal doesn't really make very much sense.
Right. Okay. And as interest rates come down, that math gets a little bit more friendly, but it's probably higher for longer. You mentioned your concern about sort of the picks and shovels, I'll say, emphasis right now. So how do you think about winners and losers in the stack, particularly given your affinity for SaaS? How do you see AI? Some people have said, agentic's going to completely upend the SaaS market. Satya Nadella says it's going to be agents talking to CRUD databases. Benioff says you're clippy. No, that's not true. How do you parse through all that?
Look, it's a simple equation for us. Anytime we look at a B2B company, does the product or service create 10x value for the customer? So we charge $19.99 a month for the software. Does the customer experience $199 of value? When you experience that, it becomes the case that the cost of inaction exceeds the cost of action. And that's when people make the decision to buy. It's when they make the decision to switch software or to migrate their database. Unfortunately, a lot of value propositions we get pitched by founders are, this helps you get better observability on your data. Or if you take this and you multiply it with this other system, then you hire a data analyst, you can do all this. When we've seen products that just scale really crazily, it's because the software just does it and it has that 10x value equation.
So it kind of gets me to my last question, which is advice for entrepreneurs, whether they're, a pool cleaning company or a tech company. What do you tell entrepreneurs that are aspiring to raise capital?
Yeah, in my prior life, I was a restaurant investor at Bain Capital, large cap PE, obviously. Value propositions that win are ones that are relevant, credible, and differentiated. If you don't have all three of those, you're not going to create a big company. You have to do something that is highly important for the customer. You have to prove to them that you're capable of doing it, and you have to do it in a different way than anybody else.
Right. Rob, thanks so much for coming on theCUBE.
Good to be here.
Appreciate it.
Pleasure.
Thank you for watching our AI Capital series. This is Dave Vellante for the NYSE Wired plus theCUBE here at the New York Stock Exchange. We're right back right after this short break.